Pleasure to get to introduce today's AFC's monthly webinar. And today's topic is managing the regulatory toolkit, specifically the practical challenges to the CFPB's rulemaking guidance and how to approach them. And this month's webinar is in collaboration with Husch Blackwell. And so I have the pleasure of handing it off to a colleague and friend, Susie Seaman. Susie.
Thank you. I'm going to do a quick share of my screen here to do some slides. So I apologize for the quick. There we go. All right, so that's us. Welcome everyone. Thank you for having us. So what we're going to do in this webinar is Mike Silver and I are going to do a presentation for the first portion of the webinar, and then we're going to have a panel discussion with Derek, Ryan, and Ian, and Mike on some of the practical implications that the CFPB's non-rulemaking guidance and challenges that it's causing some AFC members and other financial services providers. So with that, real quick, I just want to introduce myself. My name is Susan Seaman. I am a regulatory partner in Husch Blackwell's Consumer Financial Services group. I advise on a 50-state basis and federal on a variety of different payment, credit, and deposit products. I have a deeper knowledge on bank partnership, federal preemption, multi-state compliance, credit cards, and point-of-sale financing. But for this particular conversation, I am also the chair of the Federal and State Trade Practices Subcommittee of the American Bar Association's Consumer Financial Services Committee. So that is basically the group that talks about federal and state UDAP, and sometimes it's just like the CFPB committee, right? So that this is a topic that we've discussed in that group for a while, the lawyers group, and I'm glad that we're being able to talk about it in other forums. Husch Blackwell joined AFC in, I believe, May of last year, and we very much have enjoyed, contributing to the organization as a law firm member. So with that, I want to let my colleague Mike Silver introduce himself as well.
Hi, everybody. Really happy to be here. Mike Silver, not to be confused with Michael Silver. There's another Michael Silver at Husch Blackwell. It's sort of been a thing. I joined just over a month ago. I was at the CFPB in the Office of Regulations for 12.5 years. I started there just about 6 weeks after the agency was stood up in 2011. Worked on a multitude of different rulemaking projects and issue areas, most notably UDAP issues, RESPA Section 8, some issues with the Office of Innovation and during the Trump administration, and more recently was the team lead for the not sufficient funds rulemaking proposal. Also worked on a lot of different guidance initiatives, so I have a lot of thoughts and perspectives to share today. I'm really happy to meet you all.
Thanks, Mike. So full disclosure, Mike's joining our team is one of the reasons why we chose this topic, because he has, great insight on it. So that's the name of so again, like I said at the beginning, we're going to do a quick kind of presentation on the front portion of the webinar. We're going to talk about, okay, what's happening? Why is there increased issuance of non-rulemaking guidance? Kind of explain the different types of guidance that the CFPB has been issuing, because there's a lot of different types. If we have time, we're going to go over some recent noteworthy CFPB guidance that may be of interest, particularly to AFC members, to just kind of put some of these types of guidance in context. Some examples are helpful. And then we're going to open it up on the last portion of the webinar again to a panel discussion on the compliance challenges that this non-rulemaking guidance creates. So with that, let me just kick it off to set the stage. One of the CFPB's primary functions is issuing rules, orders, and guidance. And they've done it since the inception of the Bureau, which Mike knows. So like many other agencies, including the provincial federal regulators and the FTC, they've issued guidance. This is not a new thing. It's not necessarily a headline that they've been issuing guidance, but in 2022, we saw a noticeable uptick in the amount of guidance and the different types of guidance that the CFPB's has been issuing, and it's been fairly consistent since 2022 on the different types of guidance that have been issued. And so I put this blog post quote up here because I actually very much enjoyed this blog post by Director Chopra, but it also gives insight onto potentially one of the reasons why the CFPB issued more guidance. This whole blog post is about creating simpler and clearer rules of the road. And so this last sentence in here that the CFPB is going to increase the amount of guidance that they provide to the marketplace in order to help achieve that simple and clear rules of the road goal that they have. So like I said, there's been a noticeable uptick in the amount of guidance that has come out outside of the rulemaking process. And Mike's going to give a little bit more about, the rulemaking process and the procedural requirements, but just to be able to quantify it a bit. And I know these are 2022 stats, but I didn't have time to update them. We counted at least 21 pieces of formal non-rulemaking guidance that the CFPB issued between January 1st and December 31st of 2022. And that doesn't include all the press releases, all the remarks, that's just more the formal like interpretive rule CF circular guidance. And there's been, again, a lot of informal guidance that has been issued as well. And we'll talk about that. But Mike is going to talk about kind of the rulemaking process and, what the CFPB kind of gets to avoid when it issues guidance instead of rulemaking.
Great, thanks, Susie. So the CFPB has taken the position generally that a guidance document, as in contrast to a notice and comment rulemaking, is not subject to certain procedural requirements under the Administrative Procedure Act. That's basically the lodestar for federal administrative law and the rulemaking process. And these include certain specific requirements related to notice and comment rulemaking. And just to step back for a minute, a notice and comment rulemaking is sort of it is what it's as it sounds. It's where there's a proposed rule, where there's a solicitation of comment, generally a 60, 90-day period, followed by a period where they evaluate and consider the comments and then issue a final rule, followed by an implementation period. Typically, guidance, in contrast, will take place in terms of effectiveness immediately or in a very short period of time. Notice and comment rulemakings, of course, are published in the Federal Register. The CFPB sometimes chooses to publish the guidance documents in the Federal Register and even sometimes has chosen to solicit feedback, but they're not obligated to consider that feedback in any way. And then there's other federal procedural requirements that apply to the CFPB's issuance of rules, which may not apply to their issuance of guidance. And these would include going to the Small Business Review Panel or SBREFA process, which is something that only 3 agencies in the federal government have to do, essentially an early look of proposed rules to a panel and a group of small entity representatives. Going through guidance process doesn't entail complying with SBREFA. Additionally, the Regulatory Flexibility Act, which also concerns impacts on small entities, the Paperwork Reduction Act, and certain other Dodd-Frank Act rulemaking standards. Now, I do want to, actually, I think Susie, you have the next slide.
Oh, yeah. So as I might have mentioned or previewed, there's been a lot of guidance issued, right? So there's like a volume observation on the uptick in guidance since 2022, but there's also been a lot of new and different types of guidance that come out. And so I think a fair question that many of us have asked, well, why was that in a circular and not a policy statement or a compliance bulletin? Why was that in an advisory opinion, not an interpretive rule? Like, does it mean anything that the guidance is delivered in certain types of guidance? And I do think that there is some, something you can glean from the type of guidance that was issued. And so to help kind of organize like all this different type of guidance and help us digest this guidance that's coming out of the CFPB, Mike's just going to kind of map out the different types of guidance and talk to you about what they all mean and how they're all organized on this lovely chart.
Great. No, and Susie put together the lovely chart. So thank you. The color coding, I think, really helps. So we very intentionally frame this to show interpretive rules on the left and policy statements on the right. And I'll explain why. So in general, as Susie noted, there are just a multiplicity of types of guidance vehicles that the CFPB has been using, particularly the last 2 years. It's been a veritable fire hose of issuances. And we hear this over and over again, from clients. And I knew that this was the case, experiencing it and writing some of these things at the Bureau. But there's a waterfall of formality that applies to these different vehicles. And Susie was alluding to this. And this is something that I believe sometimes is lost in the conversation. And frankly, I think perhaps the CFPB, through their messaging apparatus, tends to blur the line to try to convey a sense that all of these things are authoritative and should be heeded with great attention, when in fact, there's a great deal of variance in the sort of legal effects of these different types of vehicles. So interpretive rules, when you're thinking about the continuum of guidance vehicles from an administrative law perspective, again, notice and comment is the most formal, but that's outside of this box for now. But within the box of guidance, interpretive rules are the next most formal type of vehicle. Interpretive rules are, in a sense, an official interpretation by the agency of the statute or regulation under their jurisdiction. And in some cases, an interpretive rule, depending on the underlying statutory or regulatory authority for issuing that interpretive rule, in some cases, a party that follows the interpretive rule and complies with it receives safe harbor protection under the statute or regulation. And that's important because, again, that is something that shows the formality of that type of vehicle as opposed to other things. Nobody is receiving safe harbor protection for complying with a statement in a tweet or a press release. But that does happen with advisory opinions, interpretive rules, and procedural rules. And just one fine point here, generally interpretive rules and advisory opinions are basically the same thing. There's just sometimes they're labeled differently. Now, policy statements are sort of one level below interpretive rules on the waterfall of formality. Policy statements are something that many agencies use and that the Bureau has used traditionally since its beginning. The so-called circular, on the other hand, is essentially a new vehicle that the CFPB just invented. And there, in fact, I believe was an initial document called a circular on circulars, which was quite an interesting nomenclature. And explaining kind of the theory behind it, which the stated theory is that the circular is intended to guide other regulators in terms of understanding the CFPB's enforcement priorities and positions. Now, in reality, everybody is paying attention to the circulars, not just the other regulators. And again, this goes to my point about how the CFPB tends to convey all of this with the same level of authoritativeness, even though as a legal matter, that's not the case. Now, there are other types of what we call formal guidance. And by formal, I think we mean things that are published either in the Federal Register, in a court filing, or under some sort of regular cadence. So as many of you know, the CFPB publishes several times a year what it calls supervisory highlights, and other regulators do this too, where they essentially summarize in an anonymous way findings and citations that have been gleaned through their supervisory activity, and they organize it by types of violation, by market, etc. There's also the exam manuals themselves. There are a number of regulatory implementation tools, compliance aids, frequently asked question documents. The CFPB sometimes files amicus briefs where they believe that there's a court, maybe there's a district court opinion that favor the equities of the Bureau, and they want to ensure that the appeals court will validate that, or vice versa. In fact, there was recently a amicus brief filed on a Fair Debt Collection Practices Act question in the 11th Circuit Court of Appeals, where the CFPB filed this brief jointly with the FTC. And what's interesting in that case and this goes to some of the sort of the patterns here and kind of the takeaways, is that that issue had to do with something called a pay-to-pay fee in a mortgage servicing context. Consumer who was in a debt collection process and was being asked to make a payment to the debt collector to actually pay the amount owed. And the CFPB first took the position in an advisory opinion in 2022, I believe, that this was a violation of the FTCPA, but then they reinforced this position in the recent amicus brief. So again, the Bureau is sort of using different types of tools in its arsenal to sketch out a particular legal position over a period of time. And then, of course, there are all the other things that we would label informal guidance, everything from writing letters to other regulators, the press releases, director statements, blogs, tweets, etc. One of our partners at Husch that Susie and I work closely with joked that maybe the Bureau should also be doing smoke signals that would probably carry the same level of informality as some of these other things, and definitely would get people's attention. The other thing is that there could be a longer discussion about this, but we don't have time, is the Bureau for a while stood up an innovation program that was quite robust in 2019. And they issued a number of different types of documents, no action letters, trial disclosure waivers, compliance assistance, approval orders. The Bureau backed off this approach under the Chopra administration, and most of those vehicles are no longer available. Those types of things are one-off grants of regulatory relief to individual parties. So they're not broadly applicable guidance, but of course, like any of these other things, they are a clue, a signal of the Bureau's position on a particular set of issues. So I do want to go to the next slide. So this very briefly at a high level sketches out the benefits and drawbacks of guidance. And again, guidance is a very wide range of different types of things. So maybe for purposes of this slide, assume something a little more formal, like a policy statement or an interpreted rule. And so there are many considerations at play, but I think some of the ones that we should highlight are the benefit of guidance is that it's a more nimble vehicle. It could be drafted much more quickly, and it can address targeted issues. Guidance can be used as a way to be responsive to stakeholder feedback, whether it's relating to the ambiguities in a rule or compliance challenges. A tangible example is when the TILA-RESPA mortgage disclosures were implemented in the early 2010s. There was an 18-month implementation period. The Bureau heard a lot of feedback from industry about various operational challenges and the like, and they did several rounds of frequently asked questions, as well as some rule changes too, to actually like synthesize those that feedback and then work it into the process. And then depending on statutory authority, as I mentioned before, there could be safe harbors. Now the drawbacks, again, these are probably pretty obvious. Lack of comprehensively treating an issue means the guidance might leave more questions than it answers. Doesn't benefit from public comments typically, and it may be more susceptible to an agency's change in direction. Susie?
Okay, before we go into the panel discussion, which is coming quickly, maybe Mike and I can highlight one piece of noteworthy guidance each, and then we can go into the panel discussion. So we prepared 4, but there's a number of different pieces of guidance that are out there and that would be relevant to you all, but we just thought to pick a few of them. So as an example. So I'm going to talk about the advisory opinion in November 2020 on earned wage access treatment under the Truth in Lending Act. So this is an advisory opinion. It's an interpretive rule. The purpose of it is to address an ambiguity in the law, right? So it's a CFPB's interpretation of an ambiguous term in the law. And, when advisory opinions come out, again, it's a CFPB's interpretation. So if you like the interpretation, great. It has a lot of weight. We can rely on it. If you don't like the interpretation, just remember it's a CFPB's interpretation and that courts ultimately interpret the law, right? But this was a helpful one. It addressed whether an earned wage access program, and I know many of you AFC members are in this space and are familiar with this, but the advisory opinion addressed whether an earned wage access program with certain characteristics is credit under Reg Z and TILA. And so in the advisory opinion, you get the CFPB's analysis of why this particular EWA program with certain characteristics is not credit with their view. And they also explained in their explanation of the plain language of the statute and, you know, the elements of the program that our conclusion in this advisory opinion per the CFPB is consistent with Reg Z's official interpretation, a comment in the official interpretation. And as Mike probably knows, the CFPB's prior discussion of earned wage access in connection with the 2017 payday loan rule. So that consistency of interpretation, especially when we're seeing recently some changes in interpretation, I think is a notable aspect of this advisory opinion. And I, as some of you may know or agree on the call, many programs built their program around this advisory opinion, right? So there is a reliance on it. So, you know, you can imagine that if these advisory opinions are adjusted in the future, you know, the destabilizing effect that changing guidance can have, right? So again, advisory opinion explaining ambiguity in the law. That's why we're talking about it. Mike, do you want to do the abusiveness or the other one?
Let's do the circular slide 11.
Okay.
So this will illustrate a couple of the points we were discussing earlier. So just very recently, about 2 weeks ago, the Bureau issued a circular which was entitled Preferencing and Steering Practices by Digital Intermediaries for Consumer Financial Products and Services. This is guidance that was provided related to the unfair, deceptive, or abusive action practices prohibitions in the Dodd-Frank Act. And specifically, this related to a prong of the abusiveness standard, which hadn't gotten a lot of attention previously. This is the so-called reasonable reliance prong. And so the Bureau analyzed this in the context of operators of digital comparison shopping platforms, as well as lead generators. And essentially the issue is when is a consumer reasonably relying on representations or statements when they're shopping on that type of platform, and it happens to be that the operator or lead generator is getting is taking payments so that the participants are having their rankings or ratings preferenced in some way. And so again, this is really focused on like a pay-for-play type of situation where consumer may think that the rankings are objective and based on reasonably rely on that, and in fact, there's a compensation element which is driving the placement on the platform. Now, what's interesting here is that this is the second time in just over a year that the CFPB has issued guidance on this very topic on digital comparison shopping platforms. There was an advisory opinion under RESPA Section 8, which is an anti-kickback requirement and prohibition, which I worked on in 2023. And that advisory opinion did touch on UDAP, but very briefly, and mainly focused on the application of the anti-kickback requirements to payments made by participants on mortgage comparison shopping platforms. Now, to illustrate the point again, this is an example where the Bureau issued two different types of guidance documents covering essentially the same issue, give or take the mortgage piece of the first one. So it's essentially a Venn diagram of coverage. And as we've been talking with some clients about complying and answering questions, our guidance to them has been, look at both of these documents. Even if, there's not a mortgage piece of the site involved, the principles are very aligned, and there's overlapping legal concepts, and it's just overlapping territory. And again, just the final point here to re-emphasize something I said earlier, this is another example of where the Bureau is sort of messaging both of these types of guidance as having the same effect and trying to say the Bureau takes action to address X, Y, or Z. But the RESPA advisory opinion was a more formal issuance that had language like shall, whereas the circular was a less formal issuance that had language like might be or maybe or likely is, and doesn't carry safe harbor protection. So the bottom line is, with every guide, and I'm sure this will come up in the panel discussion, with all these different vehicles, the task really is to get past the sort of initial noise and the framing and the messaging, and to really try to digest what exactly is going on here as a vehicle.
Okay. With that, let's see here. We're going to move on to the panel discussion, and I want to thank Derek, Ian, and Ryan for taking the time to just talk about the practical impact that the CFPB's guidance, non-rulemaking guidance has had. So to just kick things off with kind of an open-ended discussion, what are some practical challenges that your companies have faced in digesting and responding to this non-rulemaking guidance that has come out of the CFPB?
I'll take that first. So thanks everyone, and great to see your presentation at the start. You know, Mike, loves hearing about your background and experience with the CFPB. I think it's invaluable for a panel like this. So for me, I mean, there's definitely some initial uncertainty on the stickiness of the guidance. What that means is, do we really feel that this is going to be the final form of this guidance? Is there going to be more clarifications in the future? Even the data supporting their guidance might be suspect. It could be incomplete or not quite comprehensive enough yet. You know, something that you get the benefit of when you do have that comment period, right? You know, definitely skips out on that piece of it. So, you know, you mentioned all the different types of guidance that it can come through, and that also creates some complexity and some uncertainty, because it's like, what is the true avenue for guidance, right? If it's coming in all these different ways, and it seems like they're cherry picking which one they're going to use at a certain time. It's like, okay, multiple choice. You can't say answer A 5 times in a row. That's suspect, right? That's not, they have to mix it up. So, you know, one of the questions I saw in the Q&A is like, what about enforcement actions and regulatory exams or consent orders? And I agree. I think that does count as informal guidance in a way. I mean, but those are also very nuanced and specific to the institution. So I take them with a grain of salt, you know, potentially a best practice. But again, that I agree that is also a way that they kind of soft push their preferences and guidance.
And I want to echo everything Derek just said, especially by thanking Mike and Susie for the beginning part of this panel, this webinar. It was really interesting. You know, I think similar to what Derek said, like, we really see this almost like as an opportunity to have more engagement with federal regulators, not just the CFPB, but really like everywhere, because of the fact that you're right, like the regulatory story hasn't been fully written yet, right? It's still almost like being drafted, and so it does provide us an opportunity to be like overly focused on like building partnerships and making sure that we're educating. And I think what we often find, like almost uniformly, is regulators interested in listening and really cognizant of how important their voice is. And so I think we've been, you know, not pleasantly surprised, but we've been, you know, it's been encouraging to see how seriously they take all of their advisory opinions and really everything they do, because they understand, even for something like EWA and like a TILA disclosure doesn't automatically trigger anything new based on how low the fees are or how it's free, right? I mean, there's new disclosures, but not even APR disclosures, because everyone in the industry charges so little. They still understand just what an impact would have throughout the country in other jurisdictions. And I think that's been it's been, you know, a like an opportunity to really focus on education. And it's been great to find willing partners, I think, in the CFPB. Like that's really, I think, the most that new companies, new industries really can ever hope for. It really does. It's great to see that like the politics is actually taken out of a lot of these decisions. Because otherwise, if it was just a political one, like I think we would be in much more trouble, because if you don't focus on the facts of what EWA really is, the real life impacts, you read the headlines, it reads like a no-brainer. And so it's really encouraging to see regulators take like a thoughtful and careful approach.
Yeah, so just building on what Derek and Ryan has said, I think, you know, it illustrates the challenge of for setting aside CFPB for a second, the challenge of going after some smart people. We were saying some very good things, but I'll try to say something slightly different. I think, you know, from an industry perspective, there's really, you know, a key pillar of good administrative policy is to ensure that there's continuity kind of across the board and, you know, throughout administrations, and, you know, really help encourage settled expectations within the market. So when you have non-binding guidance, it does create sort of less clarity, a little more contentiousness at times, although some of the rulemakings that have gone forward at CFPB have been quite contentious. And then there's just that lack of continuity, like some of the other panelists have said, that you know, the Bureau can kind of pick and choose. And, you know, ultimately for companies that are engaging in this, you know, a lot of AFC members are some smaller companies, and they're trying to dedicate very specific and measured resources to complying and to ensuring that they're adapting to the signals that CFPB is putting forward, and they're doing it, you know, in a compliance first fashion. And ultimately, if those rules of the road change, then they can be really lost with a bad situation from a compliance end as well as a financial end.
Yeah, and am I on mute? I'm not on mute. I think one thing I would no, those are all great points, and I'm glad that we have different industries represented too, because I think the guidance is you know, taken by people and different different parts of their maturity as a company, and different products differently, because it affects everyone differently. But one thing that I have noticed in my practice is some of this guidance and scrutiny also requires level setting by companies on, like, this is non-binding. This is, you know, we don't have a formal rule yet, because investors and people outside of like our sphere can get spooked, right? Or management can get spooked pretty quickly. So it's like taking a breath once guidance comes out and really saying what this is and what this is not is one practical challenge that I've observed from my practice. So Mike, do you have anything to add on this first question, or should we move to the next one?
Let me just briefly add, with regards to the question in the chat. I agree that you get back. I would view a consent order as either falling in the what we call the formal guidance bucket or informal guidance bucket. I think it sort of straddles the line with a bit. I think your leadership, particularly under Order A, was often very explicit that people should pay close attention to the all of the consent order. This became a real issue with the rest of Section 1 jurisprudence, so that there is not too many rulemaking that were also that did a number of enforcement actions in years. But of course, as I think someone noted earlier, consent orders are a product of a negotiated settlement between the parties, and so those particular nuances that relate either to the parties themselves, the conduct of the parties, or the dynamics of the negotiation. So we're going so far that you can, there's only so much you can glean from it. Now, of course, the position taken in a litigation motion or complaint, I think is definitely a strong signal to the additional evolution, and that probably will fall level credit. Yeah. Let's take one.
Thanks. Yeah, thanks for answering the question in the chat that I haven't looked at yet. So let's go on to the next question. So this non-rulemaking guidance is not binding. So it seems like there's there is a risk calculus that goes into how much do we adjust our program and practices in response to this guidance, because it's from the CFPB, so we should take it under advisement. But if you all could just kind of talk about how you view non-rulemaking guidance and your process for kind of doing a risk assessment and doing any regulatory change management that you think is warranted.
So I'm happy to kick things off from more of a broader, high level industry perspective. I think what we've seen is that it's kind of facts and specifics or contingent upon the specific facts in a given situation for individual companies. If they're kind of going back to the previous point about where they're at in their maturity, where they're at in their engagement, how involved their board members are. I mean, it can really change the risk dynamics, and also, as far as the non-binding guidance, how core is that non-binding guidance to their business? Is it something that if it goes one way, it's an existential threat? And so, you see differences among the various industry players and how they're engaging and how seriously they take, whether it be, a signaling from a regulation by enforcement, or whether it's, even a blog post or a tweet. If they're very hyper aware because it's something that is core to their business, they're going to be a bit more conservative, at least in our experience, than if it's something that's, somewhat separate from their business.
Yeah, I mean, I agree with Ian, right? DR Bank, we're under 10 billion in assets, so we aren't directly supervised by the CFPB. So anything that comes out, we're immediately doing a sense check of, does this apply to us, by definition? And if it potentially does, even if not, right, is it really a best practice that we should be doing anyways? I mean, the first thing to look at is like, what is the cost to comply with this? Are we as a small bank able to comply with the spirit of what they're trying to do here? And will this actually benefit our customers or the customers of our fintech partners? I think that's ultimately the goal here, in part of the CFPB's mission. But sometimes I think some of the rules or guidances can have unintended consequences. But in terms of a risk assessment internally, if we figure that it does apply to products or services that we offer, I mean, we're then looking at whether there are changes required for existing controls or if new controls are needed, whether that changes our oversight responsibility for our fintech partners. It might also impact due diligence, right, for onboarding new customers. As well as potentially new data requirements that we have to get from them or that we have to report out. All of these impact potential resource needs, right? Do we need to pull in people from other things to do this now, or do we need to go out and get more resources, right? That's part of the cost to comply. Do we have to potentially remediate anything that we were doing? Is there a change in disclosures? There's just so much that can happen. And I think the big bogey is is there a system or a model change, right? Because those are the types of things that definitely take time and can have wide-ranging impacts to the overall profitability and revenue from any business.
Yeah, and I would say I think what we have seen so far is we've seen, at least for earned wage access specifically, there was really two advisory opinions, right? One for the industry, one just for PayActive, who is a member of the American FinTech Council, and taken together, that was really like a roadmap for how to go forward. And I think the industry was better off for it. And I also think that the CFPB had been doing its homework, but also because of like the open dialogue with industry for months prior to that, there like the cost to comply and the ability to comply was like already there. We did not have to really change any business practices, and I think that goes for almost all of the employer integrated EWA companies. And I think that as we go forward, there's really been almost like a proactive industry effort to try to get really like more compliance guardrails set up with the regulator. So it's almost like we're trying to like ask for more regulation in order to minimize our own risk. And I think like that's probably unique to a financial wellness program like earned wage access that is like proactively seeking more data disclosure programs that are formalized with a federal regulator. We do take like I think we're seeing buy now pay later do that as well, but not in as coordinated an effort as the EWA companies, which I think share like a lot more of the same characteristics than maybe some BNPL companies do. So that's been like the kind of unique approach. There's a lot of things that are unique about EWA, and I think that could be definitely one of them.
And Ryan, no, that's a great point, and I'm gonna reference that again when I asked the third question here, but I just want to go back to one thing Derek said about the time and the resources and talking to your partners, and I think that that's one of the real challenges with just the amount, the volume of guidance that's coming out. I mean, the resources and the pace of it to keep on top of everything is at some point has a pretty draining effect on resources. And I can make this comment later, but I think that that's one of the practical challenges, right? Having to reallocate resources to respond to this guidance. But moving to the third,
and I was going to say, I think a lot of it too is like, these are all things that take a lot of time, right? All the companies that are members of AFC are usually doing something new, and this is not something that fits easily into a tweet, right? Or into even like a one pager sometimes. And so the resource allocation a lot of times is like having the time and getting the attention of people to provide the opportunity to educate them when they're federal regulators and they have 100,000 other things to do. And like someone just left, sorry, Mike, right? But like I think like that's like an important piece of it as well.
Yeah. So Ryan, I think you described a great benefit that the guidance can have on an industry with EWA and providing those guardrails and that stability and that certainty. And I know, Derek, in our preparation call, you also said, hey, this is great when guidance, gives us clearer rules of the road, right? But we have seen, so in 2023, we've seen some guidance change, and sometimes it's changed because of an successful industry challenge like the UDAP exam manual. Sometimes it's changed because the CFPB changes positions on something. Can you all just talk about the effects of if guidance isn't consistent, what in the future, what does that effect have on your business?
Trying to think where to start on that.
I know it's open-ended.
in a lot of ways, right? We always are striving to be compliant, and we want to follow the spirit of what the CFPB is trying to do. Sometimes they come out with something brand new, like an all new requirement. I think that is what's going to face the most industry backlash, right? Whereas if they're clarifying a gray area, I think they can improve efficiency, they can enhance the fairness of various products and services that everyone's trying to offer, like when used the right way. But when they go too far trying to implement some brand new thing, like that's when you really have to take a step back and kind of read the room. Like what is the industry saying? And And truthfully, we look to AFC, in matters like this to say, like, how strong is that response? How do I really need to dive into this head first? Because you don't want to be in a position where, like, okay, we're going to implement this, and suddenly guidance changes, and you've now taken that loss. You've wasted that time, you've wasted those resources, and that is, very frustrating.
And just building off Derek's point, I think that, going back to something I said earlier about the key pillar of good administrative policy is to have that ability to, encourage settled expectations within the market. That's important, for companies of all shapes and sizes. And, ultimately when you have a regulator that if they're going to pursue non-binding guidance, then it creates this confusion, and especially when you combine that with various state authorities that can, take different approaches, it can lead to just a mind-numbingly complicated regulatory environment that I know we're all paid to engage with, and we're very happy to be employed, but at the same time, it's not for the benefit of the companies, and also not for the benefit of the consumers whom those companies are trying to serve responsibly. And ultimately, those are the folks that lose out, because those companies are having to spend a lot more resources, as Derek said, on compliance, as opposed to the resources that should be allocated to engaging in, new and innovative products.
And I was gonna say, I think I think fortunately, especially at the CFPB, they understand the loud voice that they have, right? And how important their changes are, how, all the collateral consequences, negative and positive. And I think that's because of both the career staff that's there. I think it's because of the policy staff that's very thoughtful. There's a lot of economists, right? It's we say that it's one of the hardest agencies to lobby, because it's mostly enforcement attorneys, it's policy specialists, and it's economists, right? It's not politicians and their staffers. So I think they are extreme. I think the CFPB is probably the federal agency that is most cognizant of how impactful their voice is and when they speak, which is why we see them do it, I think, in a very methodical way. I think the things that they announce when there's going to be a policy change does not come as a surprise, which I think is really important. I think it's EWA, on the other hand, has been more unique, where we're not exactly sure what they're going to say at the end of the Biden administration. And we've been really thinking that when the Biden administration started, we definitely expected, I think, to hear something a lot sooner. And as the year progresses, it gets more and more clear that they're taking a thoughtful wait and see approach to see what other states are doing to really think about the collateral consequences that are negative and positive that would come with any sort of change, which I do think is encouraging. And not to say that Treasury and IRS are not similar agencies that are just as thoughtful, but I think the CFPB, because they deal with so many new entrants to the market, new industries, they are uniquely positioned to bring about a lot of change really quickly, and they're also uniquely careful for that reason.
Mike, do you feel like your voice has gotten quieter in the month that you've been at Husch Blackwell? Coming from the CFPB?
It has.
It has. Oh, you're on mute, Mike.
So it's been silenced. No, I'm just kidding.
See? Oh, I couldn't plan that better. That was great.
Set them up.
Yeah.
I mean, I think my voice is going to get louder as I get more settled in and immersing comfortable in asserting my views on things. When you're inside of a giant machine, you can voice your views on any other thing, but you're just the voice within the machine. So I think my comment on this issue is that what concerns me is the inconsistency, and this picking up on first role, the inconsistency and the notion that a guidance issuance would somehow signal a policy change that will override a rule or a more formal guidance issuance from like bureaus past. And I think, and to me, this problem goes like a little bit beyond the notion of different policies and set by different administrations, which is like a natural part of the federal government and you think elections like all elections have consequences, so to speak. I think the issue with the CFPB in this respect is that the shifts are not just the policies themselves, but the philosophy behind the policy. So like I think the innovation program that I alluded to during the slide is a good example. There was an innovation program under which program called Project Catalyst, and the sort of famously laid out not as successful as it could have been. I think there was only one launch another issue during that time. Director Kranger made it a real priority, and well, she really was bullish on this. Like even after she left the bureau, she made a public statement saying, you know, issuing no action letters is like one of the proudest accomplishments during her tenure. And they really stood up a program that I think had a lot of teeth behind it, a lot of nuance, you know, different buckets for companies, innovators to kind of see different types of vehicles to get regulatory relief. And that was sort of going on for a couple of years. And then not as much during the acting director's time in 2021, but in 2022, there was a real shift where even the Office of Innovation itself was like housed under a different division. It used to be under the director's office, which was conveyed importance. And then they were moved to RMR, Research Multiple Regulation, and were rebranded as Office of Innovation and Competition. And they, most of those tools were actually never saw the closure desire were the closing announcement down the Bureau was no longer fielding requests. And the blog post that Susie will go to on the other slide, I think, is sort of very related to this, in that the leadership's now their new philosophy is that somehow there's something I don't want to say inappropriate, that's probably too strong of a word, but something not as ideal where the innovation function is really in the business of giving the root to individual parties as opposed to broad guidance to all parties. Right, so their philosophy now is that we want to issue guidance that applies to everybody, and not just sort of favor those who have the means to submit an application. And people can debate the merits of individual regulatory review versus public guidance, but this shows that the Bureau, in the span of 2 years, after they really stood up this program that got a lot of takeoff, totally shifted course and is now taking an entirely different approach to innovation. And to me, that shows maybe the organization is now mature and will public pivot.
Great points.
So I'm going to combine the last two questions. Has there been anything about the recent issuance of non-rulemaking guidance under Director Chopra that has been just particularly concerning to you in terms of observations? It's intended to provide clearer rules of the road, but is there something else? Is there just an observation that you want to share about maybe something you do or do not like about the current practice of issuing non-rulemaking guidance? And then, if we have a change of administration in the future, what kind of difference do you see in terms of the use of non-rulemaking guidance? What may or may not change in the future from what we're living through right now?
I'll go first. I think the first part of your question, in terms of the particularly concerning aspect, I don't know if anything is that severe in my view. I think one of the themes over the past year or so has been the concept of junk fees, right? We hear that over and over again. But at the same token, like that sometimes undermines, the trust that we're trying to build as a bank, as a banking industry and as financial products, to say that, these banks that you've trusted with your money are actually charging you junk fees, right? And I think that somewhat undermines the industry as a whole to keep referring to them that way, not denying that there might be bad actors out there. And I think the vast majority of players in the industry are charging fees in accordance with existing law, right? You know, all the fees that are charged today, you know, that we charge are part of existing rules and regulations. So that to come back and say that, you know, banks as a whole are charging these junk fees and you shouldn't trust them kind of undermines. So I haven't been a huge fan of that phrase or that terminology. I think it works against a lot of what the CFPB is trying to do, which is enhance the trust that a consumer should have with their bank. So I think that is the only concerning aspect of this for me. In terms of like future administrations, you know, I feel like if the administration is unchanged in November, we might see the same kind of cadence and rigor and speed with which these come out. But if the administration changes, I think my view is that we might see it slow down or even dry up, which is kind of what we experienced previously.
Yeah, I think regardless of like who's in the White House, I think the federal like agency engagement is really like the most important work that we probably do here at DailyPay in the public policy on the public policy team. I think there's always opportunity, I think, for more for better and clearer guidance. I think there's both from a CFPB that's run by a Cordray or a Kreninger, and it seems that I think the path forward has always been pretty thoughtful when it comes to entrants as new as EWA, and so I can't imagine that it's going to stop being as data driven of an agency as it I think always has been, which I think is a good thing. I think that it does again like require a great deal of time and a great deal of education and a great deal of work, because there are so many other priorities, especially when the CFPB is really working to do so many big new things with legacy players, right? Which clearly was their priority at the very beginning of Rohit's directorship. So I think it's I don't believe that things are actually going to change that much from industry perspective, regardless of who's in the White House, because of the need to really continue to show up, be ready to educate, and be ready to work together, because the data doesn't really change based on who's in charge of the Bureau. And that I think does actually lead them to make decisions, especially when it's for new entrants like us.
I'll just say that I really hope that you're right, Ryan, because I think the industry benefits from an active CFPB, broadly speaking. I think it is indicative of a healthy functioning economy. If an entity like CFPB, like which you said is kind of in the middle on a lot of the political spectrum, is operating in this manner. So I fully respect the CFPB. I know maybe some of my answers didn't give that impression. I definitely like what they're doing, and I think the pace is, it's a lot sometimes, but it's for the best.
And just to briefly follow up on Derek and Ryan, your points, I think for AFC we've been able to have the benefit of having very candid conversations with the staff at all levels across divisions, and that willingness within CFPB I think speaks to the benefit to their very core. When it comes to non-binding guidance, I think about the importance of that non-binding guidance to provide the supervisory expectations, that clarity for activities that are going on in the market, and that the market has really said, or the industry has said, we would like clarity here. It becomes less beneficial when there is maybe a new or something that's maybe not been considered through a rulemaking yet, and that is being used to push a specific regulatory agenda, because again, it comes back to ensuring that consistency within the market and that durability for industry participants. And if you're engaging in something new as a regulator and providing non-binding guidance, while it does provide that administration's views, it may not actually function for a long-term solution.
Yeah. That was a great point, Ian. Thank you. It looks like we were at time. Thank you all again for participating in the panel. Thank you for the attendees for coming. We hope that you found it valuable, and we look forward to being, an active member in AFC going forward. So thank you very much.